I'm Matt Bishar with NAREIT.com here in New York City for REITWeek 2015. I'm joined by Haendel St. Juste, Executive Director with Morgan Stanley. Haendel, thank you so much for joining us today.
Thanks, Matt.
As the single-family rental model becomes more established, what patterns are you seeing among institutional investors active in this part of the market?
Sure. Now, it's a space that's been around on the public side for just over 2 years now, and REIT investors are slowly warming up to it. The space is still dominated largely by hedge funds, but we've seen the companies now with 2 years of operating experience meeting the REIT investors, a couple equity issuances. So there's been more and more opportunity for the REIT investors to interact with these companies, and as they gain more familiarity with the management teams and more comfort with the business model, they're increasingly, but slowly, investing in the space. But I think some key items remain on the horizon that people still want to see. They want to see what stabilized platforms and margins look like. We'll see that later this year as ARPI, one of the companies, stabilizes their portfolio. And more importantly, by extension on top of that, is that slowing their pace of buying, or in the case of ARPI, stopping, that'll pull forward profitability sooner, and that means paying out a dividend sooner, a material dividend. That's what a number of REIT investors have been holding out for as well. So I think the tide is shifting, but slowly.
And now turning to the multifamily sector, how does the supply-demand balance look right now, particularly in urban markets that are targeting millennials?
Sure. We've seen for the past, well, I guess we're in the second year now that supply has returned above its long-term average. But remember, we're still operating from a period where from 2010, 2013, we were operating well below the historical average. So that time period, that underproduction, is still a net benefit to the space today. Now, there are certain markets where, and I think because job growth, another key variable, has been weak. DC, for instance. I think Houston in 6 months' time will be a materially worse market, are a factor. But I think that as supply returns, the markets that it's hitting, and mainly in these downtown areas where millennials want to live, work, play, it's being absorbed relatively well. And the key, again, the improving economy, the millennials, and then people still can't get mortgages. It's still very difficult. So there are tailwinds why we still think the apartment sector can still generate above average net operating income growth for the next 2 years.
And lastly, how would you describe fundamentals in the mall sector, and is transaction activity likely to be confined to just the top end of the market?
You know, in the mall space, we've seen a number of trends. Sales have been flattening here for the past year or so, and that's important at some point in pricing negotiations, but occupancy cost ratio is still well below the long-term average. So landlords, especially landlords with better assets, still have pricing power, and you're seeing that in the average base rent numbers, in the releasing spread numbers. So those are good signs. But in the transaction side, we've seen some activity, a lot of activity more on the B side of the mall business, higher yields, assets, or portfolios with yields in the low to mid 7s range. That's been attracting private capital. They're attracted by the higher yields, the ability to generate very attractive levered returns. Less activity in the A mall space. That's historically been the case. There's just so few A malls, and there's a scarcity premium. When they trade at very low cap rates. But today, the activity has been largely centered in the B mall space, but the better end of the B mall space. We've seen some lower quality B malls on the market for a year, in some cases a year and a half now, that haven't traded. So I think that buyers are certainly concerned not only what the initial yields are, but then the relative positioning of those malls. Could they be, I think certain buyers are fine with buying the best mall in a secondary or tertiary market, or maybe the second or third best mall in a very strong market. And so for now, we're seeing that's where the sweet spot is, that B plus part of the mall transaction spectrum.
Thank you so much for your insights.
Great, thank you for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.